The Energy Transition Outlook Report, published by the International Renewable Energy Agency, or IRENA, in 2023, estimated that a cumulative $150 trillion of global investment will be required into the energy transition value chain to realise that globally agreed target goal of limiting world temperature rises to no more than 1.5 degrees Celsius by 2050. That's an average of over $5 trillion in annual terms. These are truly staggering numbers and put into context the scale of the trend towards renewables and greater electrification of the grid worldwide, a transition which will impact almost all industries over the coming decades and clearly provide significant investment opportunities and ramifications. However, 2023 provided further evidence of how major economic trends such as this rarely travel in smooth lines. And today, we'll discuss the outlook for energy transition equities in 2024 and beyond. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In today's episode, we speak to Alex Monk, a portfolio manager on the Resource Equities team at Schroders, a team he joined in 2018, having previously been a sustainable energy analyst covering the global utilities and telecommunications sectors. Alex is on the team responsible for managing the Schroder Global Energy Transition Fund, which is a strategy targeting emerging technologies and strategic industries integral to the global shift to cleaner energy. The fund invests across the energy transition value chain, which includes generation, storage, infrastructure, and distribution. But this particular strategy excludes companies with any exposure to fossil fuels or nuclear. The energy transition has to be one of, if not the most significant structural theme to impact investment markets over the next decade and beyond. The transition continues to be driven by factors from all sides. The combination of technological developments continuing to improve the economic argument for renewables, in addition to consumer behaviour and the increasing need to improve energy security driving supportive government policy. However, despite the clear long-term trends which are already well underway, this was an interesting time to speak to Alex, as 2023 was a bruising year for energy transition investors. The changing macroeconomic environment and tightening financial conditions, as well as some issues more specific to certain business models and industry segments, hit share prices which had traded up to elevated levels in some areas. We also catch up with Alex as we head into a year with some critical elections which may impact shorter-term policy decisions to which this sector is sensitive. Alex, thank you so much for sparing some time today. How are you?
Not too bad, thanks, Gordon. Had a good weekend. And what about yourself?
Yeah, very well, thank you. Very well. So we've been kind of starting these conversations off with a question which tries to get a bit of an insight into the kind of working week of an asset manager. So I wondered if there are any kind of anecdotes from company meetings or maybe just insights that you could share, or even just a kind of article or book that you've come across that might just give a bit of an insight into kind of what you've been looking at recently.
Yeah, so one of the things that we always try and do, particularly at the beginning of the year, obviously as a new year is beginning, is try and have as many company meetings as we can. So, last week I was speaking to companies all around the world. I did a couple of Chinese meetings very early, which meant a cold and windy cycle in, and then obviously some sort of US companies in the evening. The reason we do this, particularly at the beginning of the year, is just to try and understand sort of trends for the year ahead in terms of how different sectors, different businesses are sort of seeing the outlook. Some of the discussions in China have been really, really interesting. We've obviously seen China, particularly on the solar side, growing very, very quickly over the course of the last couple of years, and enormous amounts of capacity being built. And it's interesting just understanding that relative change dynamic as we head into 2024, where maybe we are seeing a slight slowing of the pace, but also maybe a bit of a capital cycle starting to form in China for the first time, which has sort of been an interesting anecdote. Elsewhere, preparing for a sort of interesting podcast later in the week, or interesting discussion with a sort of energy think tank later in the week that have some very opinionated views, which is always interesting. And then reading a book on it's about the fourth turning. Sort of, I've always been fascinated with cycles, short term, long term, and sort of these big sort of 100-year-long cycles that take place through society, and sort of coming up to potentially one of those cycles sort of starting again. So yeah, always trying to sort of understand what's going on in the world, and speaking to companies, of course, is the best way to do it.
Yeah, good stuff. Yeah, I've not come across that book, so I'll add that to my list. Yeah, thank you for that. I mean, my next question was to try and ask you to kind of give a recap of 2023. Obviously, recording this in third week of January. And 2023 was a pretty volatile year. I mean, it was had a big impact across markets, really, in terms of interest rates doing what they did, inflation expectations. But it was a particularly volatile year for the energy transition sector, and resulted in some pretty significant weakness, perhaps kind of through the back end of summer, or the kind of second half at least. And could I ask you to maybe just summarise some of the factors, maybe specific to that sector, which contributed to that decline?
Yeah, so you're certainly right about the volatility, and particularly that sort of Q3 period through the summer, where obviously we started to see almost a bit of a capitulation to some extent across the energy transition space. And I think when all was said and done, last year the energy transition space had its biggest relative underperformance in history versus sort of the broader market, which gives you a sense of sort of that volatility that's there. When we look back on last year, really it's been three things that have kind of caused that struggle from performance. So you mentioned interest rates there. That's clearly been a driver. We saw obviously as interest rates kept sort of moving up, and particularly that sort of longer end of the curve kept moving up, we saw that pressure downwards on valuations across the energy transition space. Now we saw that last year as well. If you think interest rates started really rising materially last year, we saw that big valuation decline last year too. So we got more of it again in 2023. The difference this year with the energy transition space versus 2022 was that while in 2022 we had that valuation pressure, we had enormous earnings strength. Lots of parts of the value chain were seeing very, very strong earnings growth, whether it be in sort of resi solar, heat pumps, EVs, EV charging. And so you kind of had the earnings offsetting the valuation decline. This year, or in 2023, with regards to the energy transition, we saw that valuation pressure continuing to come through. But on top of that, we then saw earnings weakness. Again, largely a function of interest rates going up again. If you think about, buying an electric vehicle or putting rooftop solar on your home, or installing a heat pump, these are large upfront capital expenditures. And when interest rates are getting a little bit higher, sort of financial conditions a little bit tighter, just the rate of change of growth, particularly after a very explosive period of demand strength, just started to ease and sort of roll over. We had some policy sort of pullback as well, which again sort of impacted that relative earnings. So you had valuation pressure from rising rates, sort of the first factor. You had earnings pressure from those rising rates, which was the second factor. And then the third factor was really just lingering supply chain issues and inflationary issues that were still impacting part of the space. I'm sure, you're familiar with some of the challenges that the offshore wind industry had last year. Again, really, that's just a function of sort of some of the cost inflation that we've seen over the course of the last couple of years as well. So it was sort of this perfect storm that kind of came along in terms of those various factors, and again, weighed on sentiment across the space after a really strong period of sort of earnings growth and share price performance over the prior couple of years.
Sure, that's a useful summary. So, I mean, perhaps with these kind of very significant market transitions, we shouldn't expect it to kind of happen in linear fashion. But looking kind of beyond these kind of shorter term headwinds, have we seen kind of any material changes or disruption in your mind to that longer term outlook, that kind of growth within your investment universe I'm talking about?
So on a long-term basis, we haven't really seen anything that's changed our long-term fundamental view. I think it would be fair to say that obviously as interest rates have gone up, as the energy transition involves changing things, which involves capital expenditure. And when interest rates are higher, that cost of capital is higher, just that capital expenditure becomes a little bit more expensive. So I think it would be fair to say that there's been an element of sort of pushing to the right a little bit. But when we think on a longer term view, we've always thought about these three forces. So costs, consumer demand, and policy support. costs continue to kind of generally trend down. So solar is a good example here. If you look at the cost of solar modules, they had a brief spike sort of during that post-pandemic period, and now are at record lows again. So again, the cost of installing solar outside of interest rates, again, is as low as it's ever been. Wind went up much more materially, and again caused some of the significant disruption that we've seen there. But we started to see again that sort of downward trend beginning. Batteries exactly the same. We're kind of on that downward trend. So costs generally are continuing to trend down, and the cost competitiveness of all these technologies continues to be there. Again, renewables may be slightly more interest rate sensitive than other forms of fuels, but again, on a sort of normalized cost view, that hasn't changed. Consumer demand, I think, generally remains as strong as ever. I think what caught the energy transition out last year was that we had enormous demand strength over the prior 3 years when everybody was stuck at home, had excess savings, interest rates were low. And so we probably kind of got above the curve of demand a little bit over the first couple of years, and it just created this air pocket where, again, as interest rates rose, a lot of that low-hanging fruit of early adopters has already adopted things like EVs, rooftop solar. We just saw that fall away at a difficult time. But generally, consumer demand, I think, remains relatively robust. And policy support, again, well, we maybe saw a little bit of stepping back. We obviously saw in the UK that sort of decision around EV, a sort of transition. Generally, policy support, if you look across the world, still looks quite strong. We've still got Inflation Reduction Act in the US, obviously a little bit to be determined at the end of the year with the US election, whether that will still be there. But generally, policy support is strong. Policy support in Europe remains kind of as strong as ever. There's still lots of policy action going on there. So again, while we've maybe seen a few hiccups there, it's really sort of been more just removing maybe unnecessary stimulus that came post-pandemic and kind of getting back to a normalized sort of rate of change. So when we look at those three forces, nothing's really changed. And we're kind of likening this period a little bit to the dot-com boom and bust. It's been really interesting going back and reading articles about Apple and Nokia and all the sort of phone companies that were out at the time, where you saw their sales dip in 2000, 2001 for the first time in a while as we had that sort of interest rates rising dot-com bust at the time. And again, obviously, post that, we saw all the structural drivers of technology kind of picking up and driving demand growth. Now, we're certainly very conscious that the energy transition is not necessarily technology. Phones and laptops were completely new and obviously very exciting, whereas the energy transition is maybe a little bit more about replacing some of the existing stuff we already have. But I do think there is an interesting parallel there between sort of this period of initial excitement, bit of a dip as we get to sort of that mass adoption phase, particularly when the macroeconomic situation became more complicated, but then those structural forces still being in place for the long term that will drive earnings growth across the space.
No, interesting comparison there. Thank you for that. So I guess if we combine the kind of two last questions I've asked about the kind of the de-rating that you've seen in the sector, but the long-term outlook and the kind of significant capex cycle and growth that's there, are you able to give us a sense of where valuations are now in the space that you're kind of looking at with this fund?
Yeah, so I mean, it's fascinating looking at the charts of valuations in this space over the course of the last 3 years, because, obviously we went from a period when if you go back to 2019, where valuations were very low in the space, to the end of 2020, 2021, where valuations had obviously rocketed higher in what was and will be looked back on, I think, as a bubble, sort of a great sustainability or clean tech bubble, the same way we had the dot-com bubble back in 2000. Now, what's been interesting is, over the last 2 years, we've seen a significant derating in valuations, both in 2022 and again last year. And we're now at valuations today lower than where we were in 2019 and lower than where we were sort of at the COVID lows. Now, again, you could argue there's sort of a good reason for that. Interest rates are a little bit higher, yes. But it's interesting that also I think those structural drivers that we were talking about just before have probably gotten stronger over that 4-year period as well. So we actually see valuations as being very cheap in absolute terms. So they've completely reset from that sort of bubbly high, and again, are back below where they were in sort of 2019 at this stage. And what's also really interesting is we're now at a steep discount versus the market. So if you go back to 2019, valuations were sort of in line with the broader market at the time. Cheap, but sort of in line with the broader MSCI ACWI. We now see them at about a 20% discount to the ACWI as well. We've obviously seen Magnificent Seven and sort of various other parts of those broader indexes perform exceptionally well and arguably become a little bit expensive. So it is interesting that sort of the relative valuation now is much cheaper than the broader market and the cheapest that it's ever been. And I think what we're starting to see after the turmoil of last year, where we saw earnings downgrades, valuation compression, this sort of capitulation across the space, is that the sector is just starting to forget about those longer term drivers and is pricing out that long term growth. So we do think now is a really interesting time to sort of be looking at the space valuation wise again, just because things have reset. Now, again, the headwinds that were in place last year, we're not sort of fully sure they've gone away yet. So I think we could see maybe some more volatility, at least in the short term. But certainly on a long-term view, valuations have become, probably as attractive as they've ever been if you believe in that long-term energy transition story.
Sure. My next question was kind of looking at some of the disruptive factors going on in this space. Obviously, a hugely significant change to industry and the market generally in terms of this energy transition. And with other kind of significant transitions that we've gone through, you kind of mentioned the tech comparables. There's often a lot of investment winners that come out of there, significant new businesses and new industries, but often some numerous losers that come out of that. I mean, are there any kind of significant areas that you would highlight that you think are perhaps overlooked or not being looked at closely enough in terms of being really a risk of disruption here? And perhaps as a kind of lead-on question to that, often interested in your views on the kind of large incumbent conventional energy companies and what role they are playing in the transition. Is that kind of two-part question, but I wondered if you could tackle that one.
Yeah, sure. Well, why don't I start with that one first? Because I think conventional energy is a really interesting sector at the moment. So we've certainly always believed that, the conventional energy businesses that are transitioning the fastest and sort of have credible transition plans have a really important role to play in our long-term energy system. If we think about the likes of, I say, certainly in Europe, where I think it would be fair to say that the conventional energy companies have done a good job, or even what's historically been known as oil field services, but really is now just energy services. These are just clever engineers who are out there building energy projects, whether it be offshore oil rigs or offshore wind turbines or carbon capture. These guys have expertise across this area of the value chain. These are companies that have real rights to win in our future energy system. If you think about carbon capture, hydrogen or e-fuels, where again, it's moving around complex molecules, these are businesses that understand how to manipulate and move, sort of energy generally. So, we really think that, again, the businesses that are certainly have credible transition plans that are really thinking about investing in these areas can benefit in the short term, as we transition through gas, in particular, and then ultimately to other forms of energy, with carbon capture being there. And then also be very relevant long term too. There will, of course, be casualties, I think, in the conventional energy space, those businesses that sort of have their heads in the sand and aren't transitioning. Maybe they're making fantastic returns today with conventional energy prices higher, but ultimately long term, you'd have to think that they were at risk. The other area that I always think is really interesting and maybe isn't talked about as much is things like just mobility. So, if you think about, autos as a good example here, we've obviously have some big auto brands that we're all very familiar with because we drive around in them and see them on a daily basis. It's really interesting during these periods of change how the sort of leading players can maybe get overtaken by newer startups coming through. And I think one of the big things that we saw last year was the success of maybe some of the Chinese EV brands outside of China. We've always known them to be very strong in China, where they've definitely been taking share from some of the sort of traditional auto OEMs who had built up good businesses there. It's been interesting to see some of those Chinese EV brands expanding elsewhere into the world and maybe just having a slight lead in terms of understanding the EV technology, how the battery works, how sort of the vehicle is put together. So I do think it's interesting sort of looking at industries that will still be around. Clearly we will still have cars, I think, in 2050, but maybe just whether that leadership composition will change either by geography or sort of new players coming through, and that's obviously something that we're always looking at within the strategy as well.
Yeah, sure. No, we're certainly seeing the quality of those Chinese offerings in the EV space is looks really, really impressive as well. So yeah, no, certainly think that's something to watch. The last question we tend to ask is just trying to see where you have kind of particularly high conviction in at the moment. I'm not suggesting you have to pick a kind of single stock within your whole portfolio as your kind of favourite, but is there kind of a specific area, perhaps an area of that value chain that you're looking at in the transition, or a particular area of innovation where you've got a really kind of high conviction in at the moment for the kind of medium to long term?
Yeah, it's a really difficult question because I think if you'd asked me this, 2 years ago, it'd have been very different. Given the collapse in valuations recently, we actually see kind of interesting value, kind of in, even just the existing technology. So wind, solar, electrical equipment. Generally demand there remains very, very, very strong. I think the area that gets me most excited at the moment is energy storage. If you think about stationary energy storage, I think we almost tripled annual demand last year when all was said and done. The energy storage market for utility storage and sort of domestic storage as well just exploded last year. Utilities sort of had finally worked out the use case for these technologies. They got comfortable with deploying them, building them, operating them. And it was fascinating just to see the demand strength across that part of the space when generally lots of other areas of the sector were kind of, slowing down a little bit or seeing some weakness. So I think, could there be a little bit of a risk there after the extent of the growth last year that you maybe just get some normalization of growth possibly? But equally, when you look at kind of the underlying demand drivers from utilities and capital expenditure and developers looking to build this out, we see every reason why demand in storage could continue to be very, very strong. And ultimately, storage is kind of the thing that unlocks a lot of the energy transition. Obviously, wind and solar, two of the kind of key big pillars of sort of renewable energy, we rely on energy storage to manage some of that intermittency. We need energy storage to help balance out the grid as well. We know grid constraints are sort of one of the big bottlenecks to installing more renewables. Energy storage is sort of the solution there. And I think what's also fascinating about energy storage is the innovation. Ultimately, when we look at sort of our batteries today, there hasn't really been all that much change from sort of the batteries that we first invented in sort of the 1970s. We've just sort of learned how to make them bigger, but they're still sort of lithium-ion batteries that we're all very familiar with in all the other technologies that we use. We think there's really interesting innovation going on, not just in the chemistry of sort of the existing battery technology that we have today, but also new technologies, sort of medium duration, longer duration. As we know from our phones, which tend to run out of battery very, very quickly, lithium-ion batteries are great at quickly deploying energy, but then kind of run out of juice very quickly. So there's all sorts of innovation going on around energy storage technologies that basically allow us to deploy that energy over longer periods of time, sort of weeks, hours, days, months potentially as well. So I think that's the area that certainly I get most excited about, because it feels like it's such an important pillar of the energy system, one that's coming from a very low base still in terms of sort of installations, but also where a huge amount of innovation is coming. So again, that's an area that I think is super, super exciting and where I think the growth will continue to be very, very strong structurally. Maybe we see again a little bit of a slowdown just because of how much growth there was last year. But I do think going forward, that's sort of an area to really, really watch.
Alex, some really interesting thoughts there. I really appreciate your time. Thanks so much for talking to us.
No worries at all. My pleasure. Thank you.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.